So today's webinar, as I mentioned, is about student loans. Very timely issue with college bills coming in the door. If you're not familiar with MEFA, we are a nonprofit state authority created in 1982. So we are one of many state authorities. We're a nonprofit. We do education loans as well as college savings plans and provide guidance for families. So throughout the webinar, I'm going to tell you about different tools that we have available to help you throughout this process. Again, my name is Stephanie Wells. I've been at MEFA since 2001, almost as long as my colleague Jonathan, who's been at MEFA a little bit longer than I have. And I've been working in this education financing industry since I graduated from college. Went to Bridgewater State in the 90s, early 90s. And I work with high schools, community-based organizations, and primarily I also work with colleges to help them with processing loans for their families. So here is the toolbar that you have in front of you, just a couple more housekeeping details. Everybody is on mute. We won't be taking any polls, so you don't need to raise your hand. However, we do encourage you to put your questions into the chat feature and we'll answer those. Jonathan will be answering those as we go. And we will stop a couple of times during the webinar to answer questions. So here's what we're going to cover today. Make sure everybody understands loan terminology. Some of it may be basic, but we're going to go over all of that. Throughout the whole webinar, you'll be hearing me talk about ways to minimize borrowing and the importance of minimizing borrowing, other things that you can do to help pay your bill before borrowing. Borrowing should always be a last resort. The importance of the federal direct student loans as far as this whole borrowing concept comes along. It's the place that we recommend families start, is a federal direct student loan. So we do have some good information that we'll share with you about that. And we will go through the process so folks will understand the process. Understanding the true cost of the loan, showing you some loan disclosure statements so you can get a little bit of a background view on what to look for when you're reading through the fine print. Resources, free resources from trusted resources that you can tap into throughout this process, and as well as a little bit more about the loan timing and how this process will work. Excuse me. Allergies are kicking up today. Alrighty, so let's start with our first terminology, interest rate. So the interest rate is the percentage of the amount borrowed that the lender will charge you for using its money. So some lenders offer fixed rates and or variable rates. Throughout the webinar, I might be talking a little bit about the MEFA loan just as an example. But the MEFA loan is not the only program out there, so we want to encourage folks to shop around and get the best deal that they can. But many lenders do offer fixed interest rates, which will allow you to have a consistent monthly payment for the whole term of the loan. The rate won't change, so there won't be any surprises there. A lot of people like fixed rates for their stability, but variable rates, when rates are down, could be a good option for some folks who are okay with a change in monthly payments and a change in interest rates because it will adjust with the market. One of the things I'll show you on the disclosure statements is where to look for caps on variable interest rates. So MEFA doesn't have variable interest rates for our undergraduate loans, but some lenders do offer variable rates as well as fixed interest rates. So, but you do want to make sure you know, okay, how high can this variable rate go? Because that's going to be important for you to know. And with most private loans, actually all private loans, the interest rate is typically going to be tied to your credit score, your credit rating. So when we talk about private loans or supplemental loans, alternative loans, lots of different names for them, such as loans through MEFA, we are looking at credit rating to approve the loan. So we'll get into that a little bit more. The interest rate may be tied to not only your credit rating, but also the repayment option you choose. So I'll show you that as well, some of the different repayment options that are available. Different lenders have different terms and different options, but I will show you some examples of that. So the interest rate is first and foremost the biggest number you're going to look at because it is going to be the cost of the loan. Now, the annual percentage rate is the annual cost of that loan. So that annual percentage rate is a good way to compare apples to oranges. So you could compare a fixed and a variable rate, or a loan with fees against a loan without fees, just to get a good idea of the overall cost of that loan on an annual basis. So that annual cost will include not just the interest rate cost, but also any fees, and it's a good way to, quick way to compare loans. The repayment term. The repayment term has a big influence on the cost of your loan. So the repayment term is going to be the length of time, the maximum length of time that you have to pay that loan back. With education loans, such as loans through MEFA, the direct student loan, Federal Plus loan, just to name a few, any loan is an education-specific loan, should not have any prepayment penalties. So even though you may have a 10 or a 15-year repayment term, you could always pay those loans off early to save on the overall cost of the loan. So we'll get into that a little bit too. But the repayment term is the maximum length of time that you have to pay it back. Now, obviously, if you're making minimum loan payments over the repayment term, that's going to be the maximum cost. So if you can afford to, add to the loan, maybe a little bit extra per month, or pay the loans off early, you're going to save in the overall cost of that loan. And the repayment terms and repayment options that are available can provide families flexibility when they're looking at different options that are going to meet their monthly budget. So that's something that you'll want to take into consideration. It might be easier to just defer the loan and not pay till the student graduates, but those might be more costly because you're not paying interest and principal while the student's in school, but you are being charged interest. So there's different things to consider when choosing your repayment term. So I'm going to go through some examples about that as well. But the repayment term really is going to dictate that monthly budget. So if you can afford to go with a lower, shorter repayment term, that's going to give you a higher monthly payment. You can swing that, then that might be better for the overall cost of your loan. But you really do want to choose a repayment option that's going to fit within your family's monthly budget for the monthly payment of that loan. And most lenders do offer different options to choose from. So the application and solicitation disclosure is a federal requirement of private lenders that they need to provide to folks before they even actually apply for a loan. So that should be easily found on any lender's website, and I'll show you where you can find it on MEFA's website. Very easy to find on our website, some not so much, so that's something you want to take into consideration, because this loan disclosure is going to give you all the fine print, all the details of that loan before you actually apply. Then when you apply for a loan, if you're approved, you'll get a new disclosure statement based on your interest rates and the repayment option, I should say, that you chose. So the one I'm going to show you now is the initial one that you'll see when you're shopping around. It provides details about the loan and the total loan cost, for example. And some lenders, some colleges also have loan comparison tools that they point families to, where you can see multiple different lenders and the type of loan options that they have. So you can also look at that when you're shopping. But things to look for when we're looking on these loan disclosures is, what are the interest rates? What are the fees? What are the total costs that we're going to be looking at for that loan? So I'm going to show you where MEFA's loan disclosure is real quick. Okay, so this is the page for the MEFA loans. And if I scroll down here to the loan detail, and you click right on this disclosure button, you'll see our undergraduate application and solicitation disclosure. So I'm going to open that up real quick for you so you can see the range of interest rates that we have, 3.75 to 5.75, and that's going to change based on the credit score of the family as well as the repayment option that you choose. So I'm not going to dig too much into this chart right here because I'm going to show you another loan payment calculator later where we'll go into a little bit more detail on the actual MEFA loan. But this is a federal form that every lender has to use the same template. So you'll be provided with the right information about every lender in the same format. So you can really compare. So you can see with MEFA, we have the fixed rate. As far as loan fees go, there are no fees associated with the MEFA loan. You can see the total cost here, the different repayment options, and the highest possible rates for each repayment option. And then on the second page is more detail about the program. So I'm going to go back to our PowerPoint here and show you a demo of a couple other loan disclosures. Now, these loan disclosure statements, I do want to let you know, are not MEFA loans. Okay, so these are other lenders. So I want to point out a few things to be cautious about and to be looking for. So the first thing you'll want to look at is, what is the interest rate? How high can it go? You want to look beyond just the advertised low interest rate. So this loan could be low as 3.75%, but that's going to be with families who have, very high credit scores. So it could also go as high as 10.125, and it is a variable interest rate. So that's based on today's rates. If we look at the next bullet here, it says what the interest rate cap is for this variable interest rate. So when I mention variable rate caps, this is what I'm talking about. With this lender, and I'm not going to name who the lender is, that rate could go as high as 25%, depending on how the market goes and how LIBOR goes. So you do want to keep an eye on that. Loan fees as well. A lot of loans may have no fees to originate the loan, but you want to look at the fine print. For this particular loan, if you're late on your payment, you'll be charged 5% of the past due amount, up to $25. There's a $20 return check fee, and there are no other loan fees other than that. So something to look at and just to be aware of. And also on the second page of the disclosure statement, this I copied from the second page of this disclosure statement where more fine print lives. It will tell you what the lender is adding to maybe prime rate or LIBOR in this instance to get their interest rate. So you can keep track. So in this example, they're using LIBOR, London Interbank Offered Rate, as their base rate. And then they're going to add part of that, a percentage, to the LIBOR rate to give you your interest rate. And the amount that they're adding could be between 3.5 and 9.875% will determine your interest rate for a variable rate loan. So this is an example of a variable rate loan disclosure statement. So let's look at a fixed rate disclosure. And with this one, I chopped up the disclosure a little bit, just did a few screenshots here. So you can see with this fixed rate loan, again, this is not a MEFA loan. Our rates are much lower than this. I stole this from another lender's site who I won't name. And the interest rates here are going to range from 6.53% to 12.19%. And that's going to be based on your credit rating. So the maximum rate will be disclosed to you after you qualify, after you're approved. So with many of these types of loans, you can get a general idea of what that highest rate might be, but you won't know your exact specific rate until after you apply and you're approved. Now, total cost of the loan, very, very important number for folks to look at, particularly when you're talking to students about borrowing. This is for a $10,000 loan. So you can see this lender has 3 different repayment options: immediate repayment, interest only, and deferred. But you can see that the interest rates go up if you defer payments. These are the highest interest rates that this lender could charge. So if you were to defer payments on this loan, the rate could be as high as 12.19. And that $10,000 loan at that highest rate, if you make minimum payments for 15 years, which is the loan term, that could cost you over $30,000. So it really is important to look at that total loan cost, not just the interest rate and not just the amount you're borrowing, because if you're making minimum payments, that's actually what you're borrowing and what you're paying back. So very important number to look at, just as if you were borrowing a loan for a mortgage, you're going to be looking at that number. Very important to do so with student loans as well. Okay, so after you've done a little research on the disclosures, something to think about is that most loans will require the student, if they're on the loan, to have a co-borrower. So lenders need someone on that loan to be credit worthy to get the loan approved, and in 99.99% of the cases, undergraduate students who have limited credit and might not be working full time are not able to borrow private loans on their own without co-signers. They are able to take out the federal direct student loans, which I'm going to talk about later in the webinar. So I'll get into more details on that, which would be for freshmen, that $5,500 loan you might have seen on a financial aid award. So that's a separate loan that we're going to talk about. But right here, when I'm talking about co-borrowers, I'm really talking about private loans, such as loans like MEFA, who would most likely require a co-borrower. And it's important for parents, if parents are on the line, to understand that if you're a co-borrower on a loan with your student, you have equal responsibility. So I do talk to a lot of families who call when the payments are due and say, well, I'm just the co-borrower. I'm not really, responsible for the loan. And I have to explain to them that anyone who signs that loan note is responsible for the loan. And in fact, with most lenders, the creditworthy co-borrower is the person that we're looking to pay back that loan. They're the person we're going to primarily communicate with because they're the ones who have the credit that got the loan approved. But everybody, including the student, if they're on the loan, is equally responsible. So it's important for everybody to know. And sometimes if you might have a little bit lower credit score and you want to get that rate, you want to get a better rate, and grandma or grandpa has an 800 credit score, adding another co-borrower, so instead of one, having two, could increase not only your chances of approval, but also decrease the interest rate that you're being charged. So having folks on the loan with good credit can help in both of those situations. And some loans do have co-borrow release options that you can look at. Sometimes those loans do have higher interest rates, so you want to be aware of that. But another way to get off of a loan later on after the student graduates is to refinance the loan. So there are ways to do co-borrow releases just by refinancing loans later on when the student graduates. So that's another option for families who are trying to get off a loan that they might have signed for. So just to recap before we get into wise borrower habits, things that are good to look at, and some strategies on how to pay that college bill. The interest rate. First thing you want to look at, it's the percentage that you're going to be charged. It's the number one driver of the cost of that loan. The APR, the annual percentage rate, is another good number to compare loans because it shows the annual cost of that loan, which would include fees if there are any fees. And you could compare variable and fixed rates that way. Because it is hard to compare a fixed rate to a low variable rate in today's loan environment, it's good to know what the annual rate will be. The repayment term is the length of time that you're given, the maximum length to pay that loan back. So the longer repayment term, the lower your monthly payments. But also the longer the repayment term, the more that total loan cost will be because you're taking longer to pay that loan back. So there are pros and cons to extending the repayment term. The application and solicitation disclosure should be very easy to find on a lender's website when you're looking at their loan details. If you are having trouble finding a disclosure statement, then that might be a sign that you want to just kind of be aware if you're not able to find it, because it is the fine print that you really want to be aware of before you apply for a loan. And again, the co-borrower is typically the person that we're looking at to get that loan approved and who has equal responsibility for the loan. Okay, so we're going to take a quick break right here. I'm going to turn over to my colleague Jonathan to throw me some questions from the audience.
Thanks, Steph. You've answered most of the questions that have come in. They've been about, or maybe you want to expand a little bit more, but the questions that I got are some of the ones that we hear fairly frequently, like, is the parent or the student taking the one borrowing the loan? And I know you spoke to that, but I don't know if you wanted to get into that a little bit more, and then if you want to have a sort of a specific one that well, we can hold that one till the end. But yeah, why don't we go for who's responsible, the student or the parent?
Okay, yeah, and that is a good question. So it depends on the type of loan. So with the federal direct student loan, which I'm going to talk about in a couple minutes, that's the loan that's on the financial aid award. For a freshman, it's $5,500. The student is the only borrower on that loan. They do not have a cosigner. But again, they're capped as a freshman to be able to only borrow $5,500. So that's a loan they're taking on their own. And that's really the only type of loan that I know of where a student can borrow without a cosigner. So if you owe more than $5,500 and you do need to borrow more, then you have to look at other options. So there's a Federal Plus loan that you can talk to your financial aid office about. They can tell you about that. That is only in the parent's name. It's a federal loan. I believe the rate is 5.3%. It has over a 4% fee. And there's also other loans through private lenders. There's loans through nonprofits like MEFA, where we have a co-borrowing situation. It's really more of a family loan, where student is a borrower as well as the co-borrower, which is oftentimes a parent. So it really depends on the loan, on who is the borrower. But in most cases, in some way, shape, or form, students are going to need assistance above and beyond that federal direct student loan.
And then I was wondering if you could say somebody wants to know who's based upon, the decision is based upon.
I'm sorry, you cut out a little bit there, John.
Okay. Somebody wanted to know, and it's a good question, I think, whose credit is the decision based upon?
Great, yeah. The credit is based on the person, typically going to be the co-borrower who has some sort of income, and the interest rate is going to be based on the highest credit score. So whoever has the highest credit score on that loan, that's what the interest rate is going to be based on. So you get that lowest rate. But the approval is typically based on the co-borrower's credit, and the interest rate is also typically based on the co-borrower's credit.
Okay, I got two more good ones for you.
Okay.
With the deferred option, does the interest still accrue while the student is in school?
Yes, that's a good question. So with any loan, except for the subsidized loan for the student, which I'll talk about, as soon as that loan, when the loan is dispersed, that's when interest starts accruing. So if you borrowed for a full year, for example, half of that is going to be sent in the fall for the fall semester bill. So interest will start accruing on that portion of the loan when it's sent to the school. So even if you're deferring payments on a loan, the interest is still accruing on that loan, even if you don't have to make the payments.
And then one more is kind of a general one, and I don't know, you can kind of decline to answer this if you want, but I thought I'd bring it up because it's sort of a counselor kind of question. And how would you counsel someone who had already a lot of student loan debt when they get to this point?
Yeah, so maybe I'm guessing it might be a parent who's borrowed and they're looking at other students to help out. Yeah, I mean, in that situation, you really want to be wise about the school that they're choosing. At this point, it might be too late to change that decision, but that's something that's very important to look at is, how much is this going to cost us for 4 years, and can we afford it, given that we already have student loans of our own or loans that we've taken out for other children? Can we afford this? And if we do take out the loan and defer it, hoping that the student will pay the loan back, are they going to be able to do that? Because everybody's credit will be affected if payments aren't made. So it is something that you want to take into consideration, all of your loan debt, not just student loans, and credit cards, bills, your total monthly budget, and see if a loan is going to fit in there, and whether or not the student will be able to assist paying back those co-signed loans later. So I hope that answers that question.
Yeah, and this is a really good kind of nuts and bolts question. Someone wants to know where they can go to see if additional payments can be made to bring down the principal, and if there is a penalty, would it say in the disclosure section?
Great. Yeah, there's, I'd have to go look back on that disclosure to see. I believe it says whether there's a prepayment penalty or not on the disclosure. I can't remember. I have to look at it in more detail, but you can always ask the lender. But in general, education loans do not have a prepayment penalty. So with MEFA, you can make larger payments at any time. Even if you defer a loan, you could always make voluntary payments while the student's in school, just to bring down that cost. They're voluntary payments so that, if you miss one, you're not going to be penalized, but you're helping to, pay down the total cost of that loan. So it is a good idea if you can prepay to do so. It'll reduce the overall interest that you're charged. Or, let's say you win the lottery, you want to pay it off soon. That would be great. Just pay it off in full. You could do that too with education loans. Now, I can't speak for other types of, home equity loans, things like that. They may have a prepayment penalty, so you want to think about that. But with education specific loans, like loans through MEFA, there's no prepayment penalties, and it's encouraged to do that, to pay it off. So a lot of families might be looking at the monthly payment, and they may choose a deferred or interest only because that's going to fit your budget. But if you're able to afford to throw a little bit more money down, even the student's loan while they're in school, make the interest payments on that, then you can do so. Basically, once a loan is dispersed, then you'll have access to the loan servicing system of the lender. You'll get an email to set up that account, and then you can go on and make voluntary payments at any time. And most lenders, I know with MEFA, we have this, a great app through a loan servicer that makes it easy to just make a payment on your cell phone. And students as a borrower would have access to that too.
Okay, now I think that's good for now. There's some other questions that'll come in, of course, and we can talk about them at the end, or I can go on and answer them. But I think that's a good sampling of questions for now. Thank you.
Sounds good. No problem. All right. So now that we have a general idea of the things to look for when assessing different loan options and shopping around, let's talk about strategies on how to pay that bill. So the first thing you'll want to look at before we get to borrowing is always going to be the last resort, is looking at savings in the form of past income and payment plans through the college in the form of present income before we look at future income in the form of borrowing. So let's say in this example, if you have a $20,000 are due for the year, this is for the whole academic year, rather than just borrowing a loan for $20,000, which would be about $200 a month approximately, one step that might be easy to do, but it's also going to cost more. Let's look at other ways. So do you have any savings? Let's tap into that. Do you have a 529 plan? If so, how do you want to use it? In this example, the parents have saved $16,000 in a 529 plan. So they've decided they're going to do $4,000 a year over 4 years. They could also just do the whole $16,000 their first year if they wanted to, and virtually avoid borrowing that first year. It really is up to you how you want to utilize your savings, and you should talk to your plan advisor on getting some advice from a certified financial planner about that. Also, hopefully student, maybe they can work over the summer, put some money towards the bill. So in this example, just by tapping into some savings, we've chopped $5,000 off the bill. And then the other thing I tell families when we're talking about what they owe, one of the first questions I'll ask is how much can you afford per month? So in this example, they owe $20,000. If the family said, I can only afford $200, then we might be just looking at the loans. However, if they said I can afford $2,000 a month, then we could put it all in the payment plan at $2,000 a month for 10 months and have the bill paid with no borrowing. but most families can't pay the full amount on a payment plan and don't have the full amount saved. That's very common. So in this example, this family has said, yeah, I think I can pay about $600 a month. So what they're going to do is put $500 a month over a 10-month payment plan. And you can find out about the payment plan through the college. It's basically an interest-free budget plan to make payments over 10 to 12 months without any interest. It's not a loan, it's just a budget plan. And so they'll do $500 a month for 10 months for that $5,000, plus they've put $5,000 in towards from savings. So we've chopped our bill in half, and then they're going to borrow the other half at $10,000 for a $100 a month payment. So there's our $600 affordable payment per month. $500 on the payment plan, $100 a month on the loan. So they still had to borrow because they didn't have all of it saved and they couldn't do all on a payment plan, but at least they've chopped that bill in half before borrowing. Now let's talk a little bit about the federal direct student loan, because we always advise families before you borrow anything, make sure that you're utilizing this federal student loan. Now this federal direct student loan is only in the student's name. The student is signing the promissory note for this loan. They will get this information on their financial aid award, and they will be told by the college's financial aid office how the processing will work. So they'll be in touch from the college. But the student is the borrower. There's no credit check. It's really the only way that a student who might be 18, limited credit, maybe no income right now, can borrow up to $27,000 as an undergraduate student and not make payments for 4 years while they're in school. And they can even defer these payments for graduate school. So it really is a nice way for students to contribute towards the bill, maybe take on some of the borrowing. If a student were to borrow the maximum amount of this loan each year, so for a freshman, the maximum is $5,500, their payment at the end of 4 years would be about $300 a month. For most students in most careers that they're looking at, that should be pretty affordable. So start here. Even if mom or dad are going to help the student pay this loan off, look at that interest rate. Right now it's 2.75%. The rates went down this year, which is great. So you can't get that type of loan. Even MEFA is at 3.75 to start. We can't even get our loan down that low. So being a nonprofit, it's a really good deal if your family needs to borrow. Now, some of you may have the loan in 2 different flavors. So part of it, based on your family's FAFSA form that you filled out, would determine if you're eligible for a subsidy of part of that loan. So the subsidized portion would be listed on a financial aid award letter separately than the unsubsidized portion. So the subsidy, if you qualify, would mean that interest is not going to accrue until the student leaves school. So it's basically interest-free while they're in school. The remainder of the loan would be unsubsidized, meaning interest will accrue while the student's in school. Some families don't qualify for that subsidy, so the full loan will be unsubsidized. It really depends on your family and what your financial aid award looks like. So the maximum amounts we can see here in the blue box in the right-hand corner, we'll look at the freshmen, for example. They could borrow a maximum of $5,500, up to $3,500 of that could be subsidized, and then the rest would be unsubsidized. So no matter what your family circumstances are, every student can borrow up to $5,500 for their freshman year. Some of it may be, the whole thing might be unsubsidized. If you were not awarded the full $5,500 on your financial aid award, it might be just that the school is trying to keep their debt down and want students to ask for, that unsubsidized loan portion. So just call the financial aid office, tell them if you want the full $5,500 to do that. Do keep in mind that there is a loan fee attached to this loan and it's deducted from the loan amount. So $5,500 is not going to be credited toward your bill. It's going to be the $5,500 minus the 1.059% fee, which would be a little over $5,400, which will be credited to your student's account. Now, students do need to sign a master promissory note online and go through what's called entrance counseling on studentaid.gov. So you can see a screenshot of the website right here, just so you know what that website looks like. And the entrance counseling is basically what the student has to go through to make sure they understand their rights and responsibilities as a federal student loan borrower. So it's basically an online quiz, so to speak. So the financial aid office at the school the student is attending will be reaching out to the student either by email or through their online school portal to go through this process before that loan money can come in. So they do have to do this. And it's very important that the student does this on their own. If you want to sit with them, mom and dad, you're more than welcome to do that. But this is only in their name. It's not in the parent's name. They're not co-signed. It is the student's responsibility and it's a legal document. So we want to make sure that students are signing their promissory note and doing their entrance counseling because they're going to be responsible for this payment. Now, no payments are due while the student's in school. However, you can make payments on the interest while the student's in school if you want to, which is always a good idea to keep that cost down. And the nice thing about this loan is that when they graduate, they'll have multiple repayment options to choose from. There's forgiveness for public service programs after 10 years of payments. There's all kinds of built-in benefits for federal student loans. For example, during this pandemic, initially there was no payments due for the last 3 months or so for these student loans. And the federal government is able to put protections in place for students with this loan. So that's why we always recommend that families start with this loan first if they need to borrow, and then look at other loan options if you still owe. Okay, so let's talk just about the loan process and how this works and how to decide what you're going to borrow if you do need to borrow. So speaking in terms of private loans, plus loans, not the federal direct student loan we just talked about, but all the other supplemental loans that you might need to be looking at. You can borrow up to the full cost of attendance minus your financial aid. So that cost of attendance is going to include book supplies, room and board, miscellaneous expenses, transportation, tuition, and fees. So you can borrow up to that amount. You don't have to borrow that full amount, but you can. I always recommend that families start with just your billed amount. So the tuition and fees, room and board of the students living on campus. You could borrow for books and transportation if you needed to, but I always recommend that families try to pay for those unbilled expenses, like spending money out of pocket so that you're not, over borrowing. Try to get the student to save over the summer to pay for their own books throughout the school year, things like that. So only borrow what you need. Try to avoid borrowing as much as you can. Now, this is an annual process. So you're only borrowing for 1 year at a time. And we do recommend that you borrow for the full academic year, not by semester, because it's just much easier for the family to lock in that loan for the year, borrow, what you think you'll need. It's always easy to call the lender before the loan is dispersed and say, I don't need that full amount for the spring, reduce my loan. It's easier to do that than having to reapply for additional funds. But we do recommend that you apply for the full year. So if you're borrowing for all 4 years, you might have 4 separate loans with 4 different monthly payments. They could even be different repayment options if you choose to do different repayment options each year. It really is up to you to make that decision, but it is an annual process. Just like you're applying for financial aid each year, you might be looking at borrowing each year. And estimate what your monthly payment will be. So if you borrow for the first year and that's going to be, let's say, $250 a month for that loan, then it's likely that you're going to be needing approximately the same amount for each of the next 3 years or 4 years, however long the student is in an undergraduate school. So just multiply that payment times 4, just so you can get an estimate. Okay, at the end of 4 years, this is what we're looking at for our total debt and our total monthly loan payments for all of our loans. Make sure that that's going to be affordable. because you don't want to just squeeze through year 1 and 2 and then come junior year, you're just tapped out. That's not going to be a good situation to be in. So you do want to project out what you think you'll be borrowing and what that payment will be, so there's no surprises. And if students are looking at helping mom and dad pay it back, then what is their salary going to be like? What are they looking to do after they graduate? Will they actually be able to pay that back? They might need money for an apartment, maybe a new car, to get to and from work. So it really is going to be a situation you really want to look into the future. Even though you have a bill right here and now, you want to project out what it's going to look like. Now, when you borrow, the school is going to split that loan up into the fall and spring semesters. So if you borrowed $10,000, for example, they're going to apply $5,000 for the fall and $5,000 for the spring. You're not going to be paying any interest on the loans until it's dispersed, okay? So you're not paying interest on your spring loan in the summer. You're only paying interest once that loan is dispersed to the school. So that's why it's easy to just call the lender and reduce the loan if you don't need the full amount. And with most lenders, such as with MEFA, we send the money directly to the college. So if you do need to borrow for, let's say, off-campus housing, we'll send the money to the college and then they'll give you a refund for any overage after they apply it to your bill. And then you can use that for rent and utilities if the student is living off campus. So that's just one example. Now, the affordability of the loan. I'm going to show you MEFA's loan payment calculator, which you can easily find on the MEFA.org website. So I'm just going to demo it for you because I think these tools are really helpful to just play around with the numbers and look at different monthly payment options. So this is MEFA's. I assume that most lenders will have similar types of programs. We put a lot of work into our calculator to make it a really great tool to guide families and help them make a good loan decision. So I'm going to put in $20,000, which is our example from the previous slide of what the family might be borrowing. And then I'm going to put in 4 years before graduation. And then I am going to use good as the borrower's credit profile. So I'll just do the one right in the middle and calculate. Very easy. So if I scroll down here, just so you can see the whole chart, you can see 5 different repayment options that MEFA offers in the different columns. So we start with the lowest interest rates and work our way up. So the 10-year loan, when you're making payments while the student is in school, is going to be the lowest cost because, number one, it has the lowest rate and the shortest repayment term. And you're also making payments of interest and principal while the student's in school. So you can see the first row shows what the payment will be when you're in school, a little over $200 a month for that 10-year loan. For the immediate repayment for 15 years, just adding that extra 15 years onto the loan, you can see it reduces that monthly payment by about $50. So that $50 could be, a difference maker that you want to look at that affordable monthly payment. Maybe that's going to help your budget a little bit better. But if you look at that third row, that total cost of the loan that I keep mentioning, you can see if you make the minimum payments for the full term of the loan, that's what you're going to be paying. So you can reduce that number yourself, like I said, by choosing lower interest rate options, lower interest rate repayment options, and making prepayments if you're able to. And then you can see the actual interest rate for someone with good credit, starting at 4.75 and working your way up. And then the APRs. So MEFA's range is 3.75 to 5.75 depending on credit and the repayment options that you chose. So those are new interest rates for MEFA for this year. Really excited and proud that we're able to get some good low interest rates, especially during these difficult times where things are uncertain. We don't want families borrowing more than they need to, and we want to make sure that cost is as low as possible. Now, it is going to be important for families to talk to people they trust, ask questions, grill the lender when you get them on the phone about the loan. Don't be shy about asking questions. Don't be shy about asking the financial aid office questions about your financial aid award. They're not going to tell you which loan to choose. They're not going to do that, but they may be able to direct you to loan comparison tools that have lenders they trust on there. With the MEFA, anybody in a country that's going to a school in this country can use a loan provided they're a US citizen or permanent resident. So you can use the loan anywhere, but just look for transparency on a lender's website. It should be clear, easy to understand, providing good guidance, and utilize free resources. I'm going to show you some resources that MEFA has. We can do one-on-one appointments with families. We have email and phone that you can call in at any time and email us. If you have questions about borrowing, you want to talk through options, that's what we're here for. That's what we were created to do. So make sure that you are, looking at the options available. Talk to your bursar, your student accounts office at the college. They can help you with the bill payment as well as payment plans as well. Now let's talk a little bit about the timing. So for the fall semester, some of you may already have your bill. Those are usually sent in June or July and are due 3 to 5 weeks later in July or August. So that bill that you get from the college is only going to include the direct costs, so tuition and fees, and if the student is living on campus, room and board. Now this year is going to be like one we've never seen before, where some schools are reducing the cost, some schools are going online. It might be a slight reduction in cost. So you might want to wait to get your bill to understand what those costs will be. Some students might choose to commute this year if they live near the campus, just for health reasons. So there might be a lot of changes like that families have to deal with this year. But be in touch with your school if you're not sure about the cost and what you should be doing there. They can help you with that. Now, every family in Massachusetts, every student has to be insured. So colleges may charge you for health insurance if you don't already have your own. So you can waive this health insurance cost, which could be up to $2,000. If you don't waive it, the school is going to have to charge you for that because the student needs to be insured. So make sure through your bill payment that you're waiving that health insurance if the student is properly insured. And you do want to check with your health insurance provider if they're going out of state, for example. Let's say you live in Massachusetts, a student's going to school in Pennsylvania. Is your health insurance going to translate over to Pennsylvania? Make sure that that's all in place, especially right now where we're in the middle of a pandemic. We want to make sure everybody has proper health care and health insurance. Your enrollment deposit that you paid is going to be deducted from your fall bill, as well as any financial aid and private scholarships that were sent to the school. If you've set up your payment plan, or even if you've already borrowed your loan and set that up, then you may see credits on your bill for those amounts as well. If the student did receive work study, which is a job that they get on campus, typically that's not deducted from the bill. Most schools will provide that on a financial aid award, and then the student has to earn that money through a part-time job. And then they can use that money that they get every couple weeks through a paycheck to use for books, supplies, those unbilled expenses that I was mentioning you should try to pay out of pocket. You do want to give yourself a good 2 weeks before the bill's due to apply for the loan and get your finances in order. Now, with that said, if you apply for a loan, for example, I'll just use MEFA as the example, it's an instant credit decision. You can have the loan application filled out and your promissory note signed in a half hour, even less. But the school still needs to certify that loan. There could be something on your credit that you're not aware of where the loan might not get approved. So you want to give yourself a cushion and give yourself some wiggle room before the bill's due. You don't want to wait till the last minute. Now, we do have lots of people who apply in late August and early September for loans, but we want you to try and do that earlier so that you're in good shape. You don't have to stress about late payment charges, things like that. Now, you may have your fall bill covered and you may decide, okay, we can swing it. We have savings for fall, we don't need it. But then maybe when the spring comes around, maybe you set up your payment plan, things are a little tight, you decide maybe we do need to borrow. You can apply at any time during the academic year if you do decide you need to borrow. And you can also set up your payment plans according to the school schedule. So you may decide you don't need a payment plan for the fall, but you want to do one for the spring, and you can do that too. So here's some resources from MEFA. If you're on social media, Facebook, Twitter, LinkedIn, YouTube, this video, for example, that we're doing right now will be on our YouTube channel. I'll email it out to everybody who registered for this webinar. But our Facebook, follow us on Facebook. We're always showing Facebook Live events, webinars that we have coming up. On Twitter, for example, we might be having Twitter chats on important topics that you want to be aware of, maybe throwing out some scholarships out there as well we tweet out. So lots of great information on our social media that you can take advantage of. Now, before I turn over for questions, I want to talk about a couple more resources for you, because I know some folks might need to log off at 1. We're at 12:52. So you might be just on your lunch break. So here's our number, 800-449-MEFA. We are open 9 to 5, Monday through Friday. Call us at any time if you want to talk about loan options, if you want to talk about financial aid, whatever it is, college savings plans, we can help you with that. If you want to just send a quick email to collegeplanning@mefa.org, you can do that as well. And also, if you want to set up a one-on-one appointment to really just sit with somebody to go over your financial aid award, look at your bill, talk about different options of how to pay that bill, you can also do that. In the email that I'll send you, there'll be a link to that one-on-one appointment request, but you can also type this hyperlink into your web browser to sign up. So it's important that you sign up for that if you want to get that one-on-one help, one-on-one assistance. So there's 3 ways for you to get assistance: phone, email, or an appointment, and it will be a virtual appointment, just like what we're doing right now. Now, before I turn over to Jonathan for questions, I also want to throw out a plug for Google reviews. If you found this webinar helpful or anything that MEFA has been helping you with through emails, through our curriculum, through our website, if we're able to help, feel free. We would love to get your feedback with a great Google review so that others who are looking at MEFA online can see the benefit that other folks are experiencing as well. Because we really are a nonprofit, not just a lender. We're here to help with the guidance and the education aspect. That's what's most important to us, is to make sure families have that good guidance and are getting good information. So with that said, get all my resources out there. I'm assuming most of you are set up for our email curriculum, so you're on our emails, but you can sign up for that on mefa.org as well. So I'm going to turn it over to Jonathan to start with the questions.
Thank you, Stephanie. We have a few, and one thing that has come up a couple of times, and I think it bears talking about, somebody asked if 4 one-year loans can be consolidated into one monthly payment once the student graduates. I don't know if you can talk about the monthly payment and then also consolidation or refinance.
Yeah, that's a great question. So, and again, I use MEFA as an example because that's what I can speak to with confidence in giving you the details and not trying to push the MEFA loan. I just want to use it as an example. If you were to borrow a MEFA loan for each of the 4 years, you would have 4 separate loans. However, it's consolidated billing. So you have one account, one online account to log into where you can make all your payments for all 4 at once. You can do auto debit. So even though you might have 4 loans, it doesn't necessarily mean it's going to be an inconvenience or difficulty in managing those loans. The way we have it all set up in our servicing system makes it very easy. So you could, however, we do have, MEFA has a refinancing loan. There's lots of different other refinancing loans out there. So families can look at that after the student graduates. For example, with MEFA, we want to see 12 months of repayment on a loan before we would refinance it. Those are options to look at. Sometimes parents want to, bulk all the loans they took out for all of their kids in one loan to help with maybe even lowering interest rates or spreading out payments, whatever the option might be. Or students sometimes want to take on those loans, and it could include federal loans as well as the private MEFA loans. So there's a difference between the refinancing, and then there's also federal loan consolidation, where you can consolidate your federal loans. So that's an option you can look at on the federal website as well. So there's consolidated billing, which it makes repayment easy. There's federal loan consolidation, and then there's education refinancing, which could be refinancing private and or federal student loans through a private lender.
Great. Somebody also wanted to know if they should take out loans per year or per semester. And I don't know if you can talk about that and about when interest starts accruing and things like that.
Yep. So interest starts accruing as soon as the loan is dispersed. You can take out loans per semester, but we do advise families to take it out for the full academic year and then lower the loan, adjust it later if you don't need the full amount. It just makes the whole process easier and smoother for the family. So interest will accrue when money's sent. So for example, if you were to apply for a loan now, you don't have to worry about any interest being assessed on that loan until 50% of that loan is sent for your fall semester bill. And then interest will only accrue on that fall bill. The spring semester monies won't be sent until January timeframe, and then interest will be accruing on the spring semester loan. So you have plenty of time to make adjustments on the loan before interest starts accruing. And even if loan monies are sent to a school, you can always have the school send the lender back a refund. So if you didn't need that amount, if you were overpaid, you can say, send that money back to MEFA. And at MEFA, we'll reverse the interest on any refunds received from the college.
Someone wants to know if we can provide a timeline for the loan process once a student is accepted into college. So I guess maybe a high level sort of, I know you spoke about this a bit, but sort of from acceptance to, I don't know, maybe the first year, maybe the 4 years, I'm not quite sure.
Yeah, so it really is an annual process. So you want to break it down by year. And once the student is accepted to a school, so let's use incoming freshmen, for people, students who are high school seniors, just graduated from high school and going into college in the fall. If we use them as an example, those bills are coming out right about now. So you do want to make sure that you have your loan in place before the bills due. So that's really the timeline that you want to work with, is look at when your bill is due and work your way back. So give yourself a couple weeks before the bill is due to apply for the loan. As far as the federal student loans go, the financial aid office will be in touch with the student, usually in the summertime for that. So you can call them if you have questions about the process for that.
Okay, I think that might do it for us.
That might be it. All right, we'll leave it open for another few seconds before I end the webinar. If anybody has any last minute questions, feel free to type those in. And for those of you who do need to log off, we want to thank you all for coming, and hopefully this is helpful. If you have any friends or family that find it would be useful, we are recording these and they're all on our website, and we'll be offering programs throughout the summer as well. So feel free to utilize our services, and thank you, Jonathan, for helping with the questions. And thanks everybody for coming. Any other questions that might have popped in last minute, Jonathan?
Oh, yes. I just answered it. Somebody wanted to know though, can you get a loan from more than one lender? I'm sorry, can you get a loan more than one? And if you're planning to borrow more and more each year, can you reapply for bigger amounts? So I guess, yeah, in a larger sense, I would say too, sometimes we get questions about the different types of, like, are you locked into a type of loan when you start, the first year? Do you have to keep going to the same type? So I don't know if you want to talk about
Right,
that.
that's a good question. So you can borrow from different lenders. I recommend sticking with a lender just to make repayment easier, to make the whole process easier. However, if you have a bad experience, you might want to switch lenders the next year. But if we use, just MEFA, for example, you are going to borrow what you need for each individual year. So you might need more one year than the next, and that's okay. We're not really looking at how much you borrowed the previous year. It really is based on credit, the approval. And You may change repayment options each year. So this year you may choose a 10-year immediate repay because it has the lowest rate, and that's going to be the repayment term for that loan. But next year you may say, you know, I really like that deferred option. Maybe I'll do a deferred this year. So you can do different repayment options each year. But once you take out a loan, that loan is locked in for the life of that loan with that repayment option and interest rate. And they are considered separate loans, but they are consolidated billing. So it's all under your one account. Any other questions coming in, Jonathan? Looks like we're good.
Pretty good. Yeah, we're pretty good.
Okay, great. Well, thank you everybody for attending today, and have a great rest of your day. Stay cool. I hope everybody's staying healthy and well, and hang in there. Talk to you soon.